Welcome to The Explainer. So, here's a wild thought for you. What if I told you that in 2026, the stock market is poised to absolutely soar to record highs, but the journey to get there could be one of the most treacherous, most volatile rides we've seen in a long, long time? That is the fascinating and kind of complicated story we're breaking down today, a story of huge optimism colliding head-on with some serious instability.
All right, let's just jump right in with the number that has everyone on Wall Street talking. 8,100. Now, this isn't just some random guess pulled out of thin air. This is the high-end target for the S&P 500 from really credible analysts. We're talking firms like Oppenheimer and Deutsche Bank. They believe the market could rocket all the way up to this incredible new high in 2026.
So you see that number, and you're thinking, okay, simple, roaring bull market, right? Well, not so fast. Because when you actually dig into what the experts are saying, the picture they paint of the path forward is way more complicated and honestly, a lot more dangerous. And that really gets to the heart of the paradox here. You've got this massive optimism about where we'll end up, but at the same time, a serious warning about the road itself. As Schwab's Liz Ann Saunders puts it, we're facing instability, not just your garden variety uncertainty. So, how can both of those things be true? Let's unpack it. So what in the world is going to push us towards that 8,100 target? Well, it all comes down to three really potent forces all firing up at the exact same time. You can think of it like a three-cylinder engine that's just revving up for this bull market. And what's so interesting here is how you have these three totally separate drivers. You've got a tech revolution, a ton of government spending, and a helpful monetary policy all converging. That kind of alignment is pretty rare, and it's creating a uniquely powerful backdrop for stocks. Okay, first up, there's this fundamental shift happening in artificial intelligence. The market is moving past the phase of just building the AI tools. By 2026, the real focus is going to be on companies actually using those tools to make everyday businesses, like banks and retailers, way more efficient and profitable. JP Morgan thinks this productivity boom alone could fuel a stunning 13 to 15% growth in earnings. That's huge.
The second driver? A huge injection of cash from the government, thanks to the One Big Beautiful Bill Act, or OBBBA for short. This thing is set to add almost a full percentage point to GDP, directly boosting company profits, and, get this, putting about $150 billion in tax refunds right into consumers' pockets, especially early in the year.
All right, so we've got this really powerful engine pushing the market higher. So, where does all this talk of instability come from? Well, to understand that, we've got to look at the calendar for 2026, because the timing of all this is absolutely everything. Analysts are basically seeing the year unfold like a four-act play. It starts off strong with that government sugar high, but then things get tricky. There's a big challenge around the Fed's leadership, and then, especially in the third quarter, things get really rocky, before finishing up with a powerful rally once all the political uncertainty is out of the way. And this right here, this chart shows you exactly why quarter three is the big boss battle of the year. Historically, the average market drop during a midterm election year is a staggering 22%. I mean, look at that difference. It's way deeper than in other years, making it the single biggest hurdle for investors to clear in 2026.
Now, to be clear, no one's base case is a full-on 22% crash, but the analyst consensus is pretty clear. You got to brace for some serious turbulence. A market pullback of somewhere between 10 to 15% is seen as highly probable when all that political uncertainty peaks in the late summer.
So what happens when you have this kind of extreme volatility? Well, it doesn't just shake things up. It creates a totally fractured landscape. Surviving this environment doesn't mean everything wins. In fact, the consensus is that it leads to a stark, really dramatic division in the market. And the best way to understand this market is through the idea of a K-shaped recovery. Just picture the letter K. You've got the top arm going up, those are your clear winners, and then you have the bottom arm going down, and those are the clear losers. This is not a market where a rising tide is going to lift all boats. So, who are the winners riding that upper arm of the K? Well, analysts are pointing to companies that cater to the resilient middle-class consumer, businesses that are actually using AI to slash their costs, and hard assets like gold and copper that tend to do really well when government debt is high.
And speaking of hard assets, just look at the conviction around gold. We are not talking about small gains here. Major banks see it as a key winner in this era of massive government spending. JP Morgan's forecast, a price that would absolutely shatter all previous records.
Okay, so what about the losers? Who's stuck on that bottom leg of the K? To understand the biggest risk here, we have to look at what BlackRock is calling the diversification mirage, and it points directly to a major area of vulnerability. So the consensus is that long-term government bonds, the stuff that's supposed to be safe, could actually be a big loser. Also, on the wrong side of the tracks in 2026 are companies that serve the squeezed low-income consumer and, interestingly, administrative staffing firms whose jobs are getting automated away by AI.
And this reality check is even hitting the world of crypto. I mean, look at this. Standard Chartered, which was a huge bull, had to cut its 2026 Bitcoin forecast in half. The whole narrative has shifted from explosive, speculative growth to a much more moderate, kind of boring appreciation driven by ETF inflows.
Okay, so let's put this all together. What's the big takeaway from this whole volatile climb? How are you supposed to think about a market that is bullish on its final destination, but so unstable in its journey?
Well, it really boils down to this. Micro becomes macro. And what that means is that the big picture, the overall direction of the market, starts to matter a whole lot less than the specific performance of individual companies. A company's own strategy, its own execution, its micro, is going to matter way more than the overall economic tide.
In Wall Street speak, we're moving from an age of beta to an age of alpha. Now, beta is basically just the return you get from riding the market wave, just owning the S&P 500. But alpha is about skill. It's about generating returns by actively picking the specific winners. It's becoming a stock picker's market.
And that leaves us with the final and most crucial question. In 2026, the challenge isn't really about timing the market's crazy swings. It's about identifying those specific companies and assets that are going to thrive in this new divided economy. So the question isn't if the market goes up, but which parts of it will you be in when it does?